Good evening and welcome to end of the week review here for SPY and trade plan I'm looking for going into next week. Real quick, I'm going to go over the trades I've done for the last, I'll call it 7 to 10 days here. On the 18th, had a nice little scalp here. Tried to catch a double bottom here off the prior low. As you can see, that failed, so it caught me off guard a little bit, took a little bit of a loss, gave some back. Then on to, what was this, Monday of this week, had a nice gap down. And if I would have been looking for further out in the future, I mean, this was the dead low day of hopefully what's going to be 2020, but we'll see if that actually does hold. Most of the time, the robots like to go ahead and come down and retest this area, dip a little bit below it, and just rip back up higher. But with the coronavirus fears and all the nonsense going on in the news, who knows if that's actually going to happen. But anyways, so I caught a nice little trade here. Took these 225 calls here at 409, scaled some out here at 525, and this little dip right here stopped me out. So did rally a little bit higher, left some on the table, but thankfully I did get out before it imploded on itself. And very similar setup to this happened later on in the week. And this is why I obey my trade plan. Once something dips back below me, I do get stopped out frequently, and sometimes I do miss larger moves, but this is one of those instances where if I would have been stubborn and did not put a stop loss in, would have given back the majority of the gains I had on that initial scale out. So here on Tuesday, good little gap up here following one of my other methodologies. I took these 245 calls here at 173, popped up here to the prior highs, sold those out here at 225, left some on the table. It is what it is. The name of the game is just making money consistently and moving on from that. Late in the day, had a nice little inside bar, actually a double inside bar almost right here. Took these 252 calls here at 115, reduced on the way up at 158 right here at this previous peak. And then it looked like there was a big seller right here. Just stopped me out, or it didn't stop me out, but I forced myself out here just around $2 on the contracts. I figured we're coming into some serious supply based on this prior peak, and maybe we're going to roll over. Obviously, that was not the case, and because that wasn't the case, maybe this was a FOMO trade, a revenge trade or whatever, even though I just made money, I did take some overnight, literally 2 contracts of this overnight here at 149. Even though it gapped up in my favor because of the volatility got crushed this day, there was a gap up, there was another day of theta burn on these calls. Ended up losing a little bit here on that trade. It is what it is. A little bit later, I did catch this inside bar break higher. Took these 265, is that 255? Yeah, 255 calls here at 126. Reduced some up here as we came into the 8 EMA, which is this blue line that coincides with the daily time frame. Took some off 151, and price action did dip below, so I had to obey my rule and got the rest out here at break even. And sadly, this is the one that actually just took off and was a monster move. So those would have been in the money by the end of the day and made up for missing a lot of this drop. So it is what it is. Sometimes that does happen, but it's better to follow the rules and look back and review and say, yes, I followed my rules. Too bad I missed that move, but it is what it is. But not to be deterred, there was some consolidation right here just below this peak. I said, you know what? I made some good money this week. Let me go ahead and put on a little bit of risk versus this chop zone between 246 and 244. Now that is a $2 range, which now that volatility is elevated, this is probably going to be the new norm for a while. So I did take these 27 March 265 calls here at 81. Immediately sold some out here on this initial pop here at $1, just locking in a nice little, what was that, about 25% gain, whatever. Then sold the rest out here at this prior peak. Again, I have to obey my levels and the plans, even though this did go up another 6 points in my favor had I held the calls. Still, it's smarter to just lock it in and sit back and relax instead of waiting for something like what happened on Friday to roll over and just absolutely demolish prices. I did take a small little overnight here onto, what was this, Wednesday. Worked out fairly nice, but it wasn't something I shared with the trade crew room, so we'll just leave it at that. Thursday, just kind of sat on my hands, didn't really do too much. Friday, Thinkorswim was acting like absolute garbage. I'm sure there's others out there that can attest to that. I went ahead, I tried to force a trade right here. I got these 260 calls here at 92. Some of them took me out here at 102 just on initial pop. And this one I was actually stubborn, and I probably should have just closed out and followed my rule, because this one is one that I did not follow my rules. The trade plan called for a target of this green line as it was coming down, and fortunately it did work out in my favor, and I did close out the rest of them at the target. But as you can see, left quite a bit on the table. But this is still, even though it's a winner, I consider that a bad trade simply because I did not follow my initial plan of go ahead and getting out when I wanted to. So onto the SPY daily pattern right here. It looks like we may be ready to roll over and come back down and create an H sell setup, which basically means as price action starts to roll over, we're going to have a couple of inside bars maybe, and then it breaks down below this. Now this was an inside bar on Friday. It's a little bit different when I go to futures here in a moment, but it is worth mentioning this can typically be used as a reversal pattern, or it could be a momentum pattern. So if it breaks above, probably going to have a significant move higher, maybe back up to the 50 and 200 SMAs up here. Down below, I have a strong feeling that we're going to go back down to at least this 217, 215 area, and as I said earlier, dip down below it before ripping up higher. So ultimately, it depends on what the market sentiment is, and if we get any more negative news out because of this coronavirus or whatever. The market seems to have liked the stimulus plan up to this point, and as I said in my last video, this coronavirus thing is only temporary, probably only going to impact 2 quarters of earnings. So to expect the market to sell off all the way back down to 2008, 2010, and maybe even 2000 bubble levels is just unrealistic to me, but that does not mean it can't happen. So we'll see what happens with that going forward. I want to zoom out here and touch on the monthly and weekly time frames real quick. Huge sell-off here the last 2 months. It was very, very obvious. And anytime we have something that looks like or similar to this candle, although there's nothing that's going to even come close to this size of a move in 1 month, you get a high volume red bar with a lower wick. This is what happened here in 2011. Something kind of similar here in May 2010. Back here at the end of the housing crisis, or near the end of it, this was October 2008. It didn't quite put in the exact low, but marked an area that were actually a level of interest, a huge amount of participation, came into the market, and things were very cheap, and it went a little bit lower. Yes, I can agree with that. It may go a little bit lower from here where we're at now, but when these types of moves happen, it's usually indicative of being close to a bottom. As I said in my last video, there are a lot of stocks that are actually, I call them stocks, but there's a lot of businesses actually that are trading at good valuations, very juicy dividends, and it's worth at least looking at long-term plays at this point. And long-term investors and pension funds, they use large amounts of capital to go ahead and take those positions. So if that's what's starting to occur here, I strongly believe we're going to be at a bottom very, very soon. I said this past Monday we're going to see a bottom within the next 3 weeks, simply because if this sell-off was due to the coronavirus fears, and we see all these headlines and articles coming out that the mass media is not publishing about this hydroxychloroquine stuff actually working, once that's more readily available as far as the news flow, more and more participants are going to see this sell-off if it pertains to the coronavirus issue. We're going to see this as a huge overreaction, whether it's technology, whether it's transports, whether it's healthcare, financials. The only sector that's not going to rebound, in my opinion, at least not as much as the rest of the market, is oil. And oil represents, or energy represents, 3% of the overall S&P 500. So to those that want to argue that the oil is what is dragging the markets down, that's all I'm going to say. Energy represents 3% of the overall S&P 500. If you use the S&P 500 to gauge the overall U.S. market, that's the kind of impact you're looking at. So with that said, go down here to the weekly time frame. Oh yeah, well here's the yearly time frame. We did actually put in an outside bar here for the year, but we've reclaimed last year's low. If we get back below this 243.67, again, there's a high likelihood, in my opinion, that we come back down to this recent low of 218.26, at least to retest it, probably dip below it before popping back higher. Okay, now onto the weekly bar. This also is an outside bar here, in a much stronger fashion, that is anyways. It is bullish, extreme amount of volume here in the last few weeks, and there's participation. That's all volume tells me. There's participation at these levels. A lot of people want to compare this to the Great Depression or the Great Recession or the dot-com bubble, whatever the case may be, the further in time you go back, the less amount of data there was available for the average investor, for these new funds, for these new people that want to actually put their money into the market. We are in 2020. There's an abundance of data out there that would suggest there are a tremendous amount of businesses trading at great opportunistic levels worth putting your money into, at least starting positions. I mean, especially if you're looking at a long-term time horizon. And those are the participants that ultimately will stabilize the market, much like I said last week. So with that in mind, it looks like there is a tremendous amount of participation at these levels. Now also with that said, if we do break this low, that may be a capitulation move, and it does flush pretty hard. Now how hard? Maybe down to 200 flat, but we are very close, at least in terms of this 218 level, we are very close to what I'm going to consider a permanent bottom. I'm not an economist, so I have no statements on how the economy is doing. All I can say is I am a trader. I do my research and I look at how companies were performing up into the impact of this coronavirus, and they were doing fine. They were growing their top and bottom lines. The largest companies that have the greatest impact were still finding ways to penetrate new markets, generate new revenues, create new products, all that good stuff. So those are all things that you want to look for in a business you want to invest in, or that I want to invest in. So real quick with that said, please take everything I'm saying, if you watch my video, for entertainment purposes only. This is not investment advice. Okay, so that's the weekly time frame here for SPY. Now I want to go over here and jump over to futures. Couple notes on here. Wrote a little script here just to identify when we have a certain scenario. That is a scenario where there are 3 green bars followed by a gap up higher. Okay, I went back all the way to, what is this, 1983, prior to the computer revolution that started to significantly impact the markets. Okay, since that time, this kind of pattern has occurred 66 total times. Well, counting this one, 67 total times, but I don't know if this is a pullback yet or not. So this has occurred 66 times. 26 of them actually continued up higher, much like this one. 46 of them generated a move. Let me zoom back here and find one that actually breaks down. It does go long periods of time without generating some of these patterns from time to time. Well, I just zoom out here. That one was another one that just continued straight up. Okay, so here we go. Something like this, we have 3 up and then a gap up higher and pulls back in. I consider this a pullback or a down move simply because it came back into the area where that 3 green bar pattern started. So this considered a move up, this considered a move down. Okay, so there is a little bit of discrepancy there in my analysis of these, so maybe it's off by 1 or 2, but the vast majority of them did actually generate a pullback. So with that said, what am I looking at going into next week? Well, I put this little purple line on here. This is an anchored VWAP. Thank you, Brian Shannon, for creating this on TradeStation. Managed to find a script here that actually pins this to this recent low. This is the level that I'm going to be using personally to see if we hold at these levels tomorrow, which will be Monday, and I will be looking to buy that because that will be a simple pullback, and if it starts to rally up higher, seems like a very logical place for it to bounce. Now if we have a gap down, or if we open up somewhere inside the body of Friday's candle and start to push down, I'll still try and buy it, but opening higher is going to be a little bit more conducive to the bears as far as their strategy to have risk versus the high, and it's going to be quite a bit tighter. They can go ahead and short huge, put their stops just above for a move higher. So I'm looking at a lot of participation going to be pushing down. If we gap down lower, right around to this this purple line right here, I'm going to look at that as taking the risk versus reward ratio away from the bears because it's so much further below what should be a logical level to place your stop against. So if we break down lower, I'm going to look at this as support. If we open up higher, I'm just going to sit and wait and see how it reacts. Okay, this is just another line on chart, another tool that I've chosen to use. I actually had one that was pinned up on this day up here that did hold for a couple of days. The first time it tested, I think it was right here. It bounced up from 3001 to 3037. Now, of course, in hindsight, that's not a significant move, but if this was a normal, quote unquote, normal market environment, 30 points would have been more than enough to go ahead and be able to trade. So with all that said, I am looking for the market to rebound and continue its move up higher, much like it was doing in the past. Now, as I zoom out here, these are just my notes as far as how many I was counting up to. This is the trend that's just recently broken, reclaimed it, December 2018 low. This was as a result of the tariffs. Now, what a lot of participants are forgetting to think about, or at least maybe they're just not saying it, the tariff war was supposed to be a long-term issue. This was supposed to impact U.S. markets, the global economy, for a long period of time. It was done and over with in that 3-month period. There's been no mention of it in the news, nothing in the headlines. Trump hasn't said anything. Now, that could come back to life because of this, what he's calling the Chinese virus, and maybe that's going to play into the next round of negotiations, whatever. The fact of the matter is, this sell-off, while I also said market was expensive, was as a result of, or they used that news headline as a catalyst to sell off because of tariffs. Tariffs technically should have been a much longer term concern than a virus that we now know has treatments available. We now know it is less deadly than the flu. We now know the actual impact as far as how many people percentage-wise it should actually affect. Okay, more and more data is coming out. I'll let you do your own research on that. But the coronavirus is going to pass, much like Ebola, much like the swine flu, much like the bird flu, and much like Zika. I mean, all these things have happened in the past. We've gotten over it, and just the media just blew everything way out of proportion. Sure, there's supply chains being disrupted and all that good stuff, but again, it will pass. Companies will get back to their growth. And yeah, just be smart about doing any kind of investing right now and do your own research, please. Don't just follow somebody blindly because they say something. So anyways, I want to touch on to the components that I like to follow for how I'm gauging the S&P. Transportation is the major key right here. It has already broken down and started to form. It kind of started to form in an H cell setup where it starts to roll over and comes back down. Transports have the airlines, some cruise lines, the trucking, the railways, all that good stuff. And if transports are getting hit, it's because there's a fear that things are not being shipped, that goods are not being purchased, they're not being utilized, consumed, whatever, however you want to word it. We know that Amazon, as I said in my last video, Amazon has delayed or postponed their same-day deliveries. They're focused on their high-demand items. They're hiring, I think it was 100,000 new employees. Maybe that's to replace some that are sick, but they're new employees. They have a demand that warrants the need for new employees. So with that said, people are at least buying from Amazon, and more so than what they can handle on the current infrastructure as of about a week or so ago. So with that in mind, maybe transports aren't that bad. This is just a result of the airlines' impact on transports. We'll see what that happens, or what happens with that going forward. Financials was my favorite, still is my favorite sector. There's a lot of banks trading at deep discounts, paying juicy dividends. And if we come back down here to the 18s again, I will buy some more Citigroup, I will buy some more Bank of America, and I will start buying some Berkshire B shares. So we'll see what happens with that. I don't think there's any reason for financials to continue to be sold off this hard. I mean, they are very cheap, at least in my opinion, and more, some due diligence to research them before putting your money to use at it, but I like what I see. Technology, the Qs right here, another inside bar, much like the SPY. What does get me is this wick where the initial selling, at least the initial as far as this chop zone has started, and we'll call it this right here, 192-ish to 195, the quote-unquote resistance area. Needs to get above there and sustain a move above there in order to be overall bullish on the market. Technology does have the highest weighting on S&P 500. I'm well aware of that. And if the technology sector, the technology sector starts to come back down to these levels, of course it's going to pull the whole market down. So I am aware of that, and I'm looking to buy some Apple, buy some more Amazon if technology does actually come back down here, even though Amazon is not technically in the queues. Or maybe it is. I'm not sure. It's categorized as consumer discretionary, so I'm not sure if it's included in the queues. But anyways, if we come back down to this level, that will surely pull a lot of the big names down to buying levels again, in my opinion, and we'll see what happens with that. So this should be Microsoft. Microsoft is the other big name right here. Looks almost identical to the queues. Same, very similar setup. Big wick right here, caught some selling here, broke through it here on Thursday. Friday though, my thought is that participants didn't want to take anything heavy over the weekend because you don't know what's going to happen. The one thing the market does not like is uncertainty. That uncertainty can be viewed as volatility in the market. So when there's fear, when there's uncertainty, of course volatility is going to be up because there's going to be these huge swings. Big participants, or any participant for that matter, doesn't want to hold into something unknown. And what can happen over 2 days when the market's not open? We don't know. So for that reason, these big swings has started to come back down, although on a little bit less volume. So if this breaks down, Microsoft is on my buy list. I will look to buy some here around 132 to 131.5 area. There's no reason for me to believe that we're going to trade below this the May 2019 levels. I mean, this is Microsoft business is not Microsoft's business is not doing worse. Let me just put it that way. If we're forced to work from home more, or if more participants, more people are forced to work from home more, that is going to benefit these technology companies. Apple, if it comes down to these 210 levels, 212, 210, I will buy it. I missed this level here. This was a trend line that I had on here last week that I threw on there last week, I believe. I should have bought here. I had my finger on the trigger. I did not. Shoulda, coulda, woulda, hindsight trader, whatever. Huge missed opportunity. But I will buy back down there. And again, this is something else that's looking like one of these H rollovers. And they like to dip below the prior low before popping back up higher. Hopefully they do that and give some people a secondary opportunity to go ahead and buy it at a good price. Amazon, which I am already in, I'm still looking for this move up to 2,200 and above. No reason for me to believe that Amazon's business is being hurt for reasons I've already said. If your business is not doing better, you're not going to buy or you're not going to invest in more employees. Now, I believe I saw New York force them to shut down one of their warehouses. Whatever, it is what it is. Try and prevent some of the transmission, whatever. Still, doesn't change the fact that demand is high for Amazon as a business. So, with all that said, I'm still bullish on the markets. I'm not letting the coronavirus scare me out of being bullish. I'm not acting out of fear. I am not acting on emotion in my trades or my investments for that matter. This is probably going to be one of those opportunities we look back on in 3, 4, 5 years and say, wow, I wish I would have absolutely loaded up on XYZ. It doesn't happen very often, and fortunately, I've been blessed to have a secondary opportunity now, the first being end of 2018, which was a tremendous opportunity that I kind of squandered. I did pick up a little bit here and there, but I really wish I would have went a lot heavier into that, and I'm looking at this as a very similar opportunity. Hopefully we get some news out of the New York trials for this hydroxychloroquine soon, and if it's anything like what's going on in, let's go through Spain, France, Malaysia, Singapore, China, Japan, all these other countries, I believe there's even some in Germany that have proven that this hydroxychloroquine stuff actually works and cures these people that has coronavirus. So if the mass media picks up on that, which they should, instead of pushing more fear into the public, this market is really going to at least stabilize until we get some guidance out of these bigger companies. So those are my thoughts for the market going forward. I hope everybody has a good weekend and good luck next week.